We are now officially in the worst recession the world has seen in the last decades. With rampant inflation, crashing markets, and sky-high interest rates, your savings are at stake. How can you make sure to preserve them and even make profit during this crisis? Michael Burry, world-class contrarian investor and multimillionaire, has the perfect strategy that made him a fortune. Keep watching as we break it down for you in this video. Michael Burry just issued what might be considered his most serious warning to date on the state of the economy and is worried the present slump may be worse than the Great Recession. He is a well-known contrarian investor who is notable for forecasting the crisis in the housing market that occurred in 2008, as well as the stock market bubble and the financial catastrophe that followed. The cause for this crisis was a rise in the subprime mortgages that went into default, which resulted in huge financial losses for investors and investment banks. Companies like Lehman Brothers and Bear Stearns either went out of business entirely or were taken over as a direct consequence of the collapse. Today, I wondered aloud if this could be worse than 2008. Burry said in a now-deleted tweet, "What interest rates are doing, exchange rates globally, central banks seem reactionary, and in cover your ass mode." Burry, the head of Scion Asset Management, mentioned that one of his market analysts called his comments spooky because he voiced his concerns on September 29th. This date marked the anniversary of a drop of 777 points in the Dow Jones Industrial Average in 2008, which was, at the time, the largest single-day drop in the history of the market. Before Burry's tweet, the Dow had already lost around 500 points, and it has lost more than 20% of its value from its all-time high of almost 37,000, which puts it in the realm of bear markets. In the last several months, the Federal Reserve and other central banks around the globe have been scrambling to increase interest rates in an effort to tamp down on inflation that's been raging like a wildfire. The World Bank and other organizations have issued warnings that the central banks run the danger of precipitating a global recession by continuing to raise interest rates in a quick and synchronous manner, despite indications that economies are beginning to decline. Burry recently tweeted, "As I said about 2008, it is like watching a plane crash. It hurts, it is not fun, and I'm not smiling." Despite massive government spending, even direct payments to millions of Americans' bank accounts, the savings rate is on course to reach an all-time low between September and December of this year. On top of this, Burry is worried about the impending sluggishness of the consumer market, pointing out the total amount of outstanding debt on revolving credit cards has increased at unseen rates. A man behind The Big Short issued a warning that he believes there is another serious threat to the stability of the market in the shape of a passive investing bubble, which he anticipates will violently burst. Burry, who has repeatedly warned that the U.S. economy is in the middle of a significant downturn, stated that the surge in popularity of passive investing, such as with ETFs and other index funds, has created a new risk for investors in the present bear market. Burry recently tweeted that the difference between now and 2000 is the passive investing bubble that inflated steadily over the last decade. All theaters are overcrowded, and the only way anyone can get out is by trampling each other. And still the door is only so big. Now, if you want to invest like Michael Burry, how should you go about it? If you're serious about replicating Burry's investment plan for the next economic downturn, you should either refrain from making any investments at all or go all into cash and wait for the crash. That's because a month ago, the hedge fund guru predicted we will soon see the mother of all crashes. Burry takes his own prediction seriously too, and it was made public in August that his hedge fund had liquidated its entire stock portfolio during the second quarter, including shares of major companies such as Google and Meta. However, you don't have to go to the same extremes that Mr. Big Short himself did. You may, instead, adopt Burry's general approach to the stock market and then tailor it to your own circumstances. Michael Burry describes himself as a contrarian investor, which means that he buys shares in unpopular businesses that have obvious deficits and then sells those shares whenever the prospects for such companies improve. Before making an investment in a business, he makes it a point to first have a deep understanding of any possible investments and make sure there's a sufficient margin for error in his analysis. This assessment of a business's fundamentals is fittingly called fundamental analysis, a method employed by the majority of value investors. Investors like Burry often use demand indicators to identify promising assets and industries. Burry has pointed out to his 1 million Twitter followers that everywhere and anywhere you see shortages, things, people, places, experiences, and services, you know the price is just not high enough yet. That's been particularly important because the COVID-19 outbreak has caused widespread shortages throughout the United States consumer market. These shortages, in Burry's view, indicate that prices can and should increase, resulting in more profits. Aside from looking at business fundamentals like profit and loss and finding supply shortages, Burry maintains strong confidence in any well-founded position. What's so noteworthy about his big short is that Burry stuck with his plan for almost 2 years when his investors started to turn on him. And in the end, it was Burry's self-assurance that paid off the doubting investors to the tune of $700 million. True to his contrarian reputation, Burry believes you should avoid the hottest new thing. For example, he's been one of the most vocal people to warn about investing in meme stocks and cryptocurrencies. In Burry's view, this is the same type of hype that fueled the real estate boom of the early 2010s. The outcome was bad for average investors back then, and he predicts it will be the same for trend chasers today. In a similar vein, Burry cautions investors to keep an eye out for large amounts of borrowed money. Bitcoin and other digital currencies, according to Burry, are not secure investments until it's understood how much debt undergirds them. Burry prefers to have a somewhat varied yet concentrated portfolio despite the fact that he has a very small number of overlapping kinds of investments. In his role as a contrarian, Burry strives to detach his investing choices from the emotions of the broader market by placing as few constraints as possible, if any, on his holdings. As long as there is value to be discovered, regardless of whether he is looking at large cap stocks, small cap stocks, mid cap stocks, technology companies, or non-tech stocks, he will consider making an investment. On the other hand, he claims that he locates the best opportunities for investment in sectors that are currently unpopular. In the same vein as Warren Buffett, Burry also looks for businesses that have a sustainable edge over their competitors and invests in such businesses if they are selling for a reasonable price. In fact, it looks like Burry did find one undervalued stock worth holding through his predicated market crash, GEO Group, private prison operator. However, it's not that unusual when you consider Burry's contrarian investment theory. He works against market trends, concentrating on possibilities in sectors where the industry is misunderstood and so mispriced. The present mood about private jail stocks can accurately be described as misunderstood. In recent years, they've been hammered in the stock market. This is mostly because, according to an executive order issued by Joe Biden in 2021, the United States Federal Bureau of Prisons is phasing out its reliance on private prison operators. That's not the end of it. The market has been worried about firms like GEO defaulting on its debts since 2019, when major banks ceased funding private jail corporations. And that's precisely the point. Burry likely bought GEO stock because he's confident these worries are exaggerated and have led to a misevaluation of the stock's price. And this is precisely how you need to think if you want to become a contrarian investor capable of inspiring a Hollywood movie. When the minority is right, it's often in a big way. I know whenever topics like contrarian investing or a looming recession come up, there will be a variety of opinions. What do you think? Is the mother of all crashes imminent, or does Burry have this one wrong?